Remember when they told you silver was a pet rock? Remember when the experts on CNBC mocked it as a dead asset that did nothing but sit in a vault collecting dust? Remember when your financial advisor laughed at you for buying monster boxes instead of Nvidia stock? Well, nobody's laughing today. It is January 19th, 2026, and if you are holding physical silver, you are having a very good day. Global markets have just opened and the verdict is clear. Silver has not merely broken out, it has gone vertical. Spot silver just printed a new all-time high at 94.3 an ounce. Take a moment to absorb that number, $94. We started this year at roughly $71. It has been only 19 days since the ball dropped in Times Square, and in those 19 days, silver has climbed more than 31%. 31% in less than 3 weeks. If you try to annualize that return, the math stops making sense. This is no longer a bull market. This is a melt-up. This is a currency collapse wearing the disguise of a price rally. Silver is outperforming Bitcoin. It is outperforming the S&P 500. It is outperforming the so-called Magnificent Seven tech stocks. The most boring asset on the planet has suddenly become the hottest trade on Wall Street. And the best part is that the mainstream financial media still does not know how to talk about it. They are scrambling for explanations. I saw a headline earlier today claiming silver is rising due to speculative flows. Speculative flows? When a market rises 31% in 19 days, that is not speculation. That is panic. That is capital fleeing a burning building and trying to squeeze through a tiny door labeled real assets. The move to $94 validates everything we have been discussing on this channel for the past year. It validates the tariff trap we analyzed recently. The market understands that silver inside the United States is effectively trapped. It knows the London vaults are cut off. As a result, the US price is exploding upward to match global reality. It also validates the sovereign default at the US Mint. The fact that you cannot buy American silver eagles from the government has forced billions of dollars of retail capital into the spot market. That demand has acted like rocket fuel under an already tight market. Most importantly, this move validates the physics of the shortage. Look at the chart. The move from $90 to $94 happened in a single session. Nearly a 5% gain overnight. This is what happens when there are no sellers left. Ask yourself a simple question. Who is selling silver at $90? Are miners selling? No. They are holding back supply, waiting for triple digits, or they have already sold their production through off-market deals to industrial buyers. Is the retail stacker selling? Absolutely not. Retail is still buying, terrified of inflation and currency debasement. Are the banks selling? We established in our last report that the banks have capitulated. They are switching sides and buying to cover their shorts. What you are left with is a market with inelastic demand and vanishing supply. In economics, when demand goes vertical and supply goes vertical, the price does not move gradually. It gaps, it explodes. In theory, it goes to infinity. We are witnessing the early stages of a hyper-monetization event. Silver is being re-rated in real time, shifting from an industrial commodity into a monetary reserve asset. At $94 an ounce, silver is no longer just an input for solar panels. It is currency. It is a store of wealth that now rivals gold. Speaking of gold, look at what the yellow metal is doing. Gold is trading near $4,730 an ounce. It is holding firm, but silver is moving faster. The gold to silver ratio is collapsing. It has fallen from nearly 60 to 1 down to roughly 49 to 1 in just weeks. This compression is the engine of the wealth transfer. It means silver is gaining purchasing power faster than gold. It means the so-called poor man's gold is making the poor man rich. But this is the moment where we need to pause and inject some reality into the euphoria. When you see a chart go parabolic and your net worth jumps 30% in a month, the natural human reaction is greed. You start doing math in your head. You start multiplying $94 by 10,000 ounces. This is exactly where danger lives. A vertical market is a fragile market. When an asset rises this fast, it attracts the wrong kind of money. It attracts hot money. It attracts leveraged junkies borrowing funds to buy contracts they cannot afford. And as we will discuss later, the banks are watching this leverage closely. They are licking their chops. They know that the higher the paper price goes, the easier it becomes to engineer a violent rug pull. Yes, silver hit $94 today. That is a fact. But do not assume tomorrow is $98 and the next day is $100 in a straight line. The road to triple digits is paved with volatility. That said, there's a new catalyst in the market that suggests this time truly may be different. There's a new buyer entering the silver market, one with deeper pockets than the banks and more urgency than retail investors. We have talked extensively about solar demand. We have talked about electric vehicles. But today, analysts are finally beginning to whisper about the AI demand shock. In the next phase of this analysis, we need to examine the intersection of artificial intelligence and silver. Because the massive data centers being built by Microsoft, Google, Amazon, and others are becoming silver black holes. You cannot have an AI revolution without a silver squeeze. This is the fundamental difference between this rally and those of 1980 or 2011. Back then, silver was primarily money. Today, silver is the nervous system of the future. So the real question becomes, why now? Why, after 40 years of stagnation, has silver suddenly woken up and sprinted to $94? Skeptics will tell you this is a bubble. They will say it is speculation. But they are missing the single largest structural shift in the global economy since the invention of the internet. We already understand the first engine. Solar panels consume more than 20% of annual silver supply. We understand the second engine. An electric vehicle uses roughly 3 times more silver than a gasoline car. But now, a third engine is coming online, and it is larger, faster, and hungrier than the first two combined. That engine is artificial intelligence. When people talk about AI, they talk about software. They talk about algorithms, chatbots, and code. What they forget is that software does not exist in a vacuum. It lives on hardware. And that hardware lives in massive data centers filled with millions of servers, miles of cabling, and billions of chips. The physics of that hardware are not negotiable. Artificial intelligence requires speed. It requires minimal resistance and near zero latency. When you ask a machine to think like a human, electrical signals must move as fast as physically possible. Only one element on the periodic table conducts electricity better than all others. It is not copper, it is not gold, it is silver. Silver is the most conductive metal known. In high-performance computing, silver is not a luxury, it is a necessity. You cannot build cutting-edge NVIDIA chips or ultra-fast server interconnects using copper alone. Copper runs hotter and slower. Silver dissipates heat and allows systems to operate at extreme performance without failure. Across the United States, Europe, and Asia, AI data centers are being built at an unprecedented pace. Microsoft, Google, Amazon, and others are spending hundreds of billions of dollars constructing the infrastructure of the future. Every one of these data centers consumes silver in contacts, soldering, switches, connectors, and semiconductor packaging. Wall Street analysts have not updated their spreadsheets yet. They are still modeling silver demand based on jewelry and silverware. They have not priced in the AI premium. They do not yet understand that the cloud is literally lined with silver. Before going deeper, it is important to address something else. We are the original channel. We do real research and provide verified information. Unfortunately, artificial copycat channels have begun appearing, using the same avatar and copying scripts word for word. We have only one official channel. We do not sell crypto. We do not operate fake social accounts. Anyone else using this identity is a copycat. Now, back to the AI demand shock. The reason this new demand source is so powerful is because of who the buyers are. When a jewelry manufacturer buys silver, price matters. But when a company like Microsoft builds a $10 billion data center, the cost of silver is irrelevant. Even if silver doubled, it would barely register in the project budget. What matters is availability. These facilities cannot function without silver. That makes demand perfectly inelastic. Big tech will pay virtually any price. If silver were $500 an ounce tomorrow, they would still buy it, because the alternative is shutting down AI operations and losing the race for the future. This is where the silver squeeze collides with the AI arms race. Tech giants remember the chip shortages of 2020. They know just-in-time delivery is a myth. As a result, they are bypassing the futures market and signing direct offtake agreements with refiners. Metal is being secured before it ever reaches public exchanges. This explains why exchange inventories continue to drain even as prices rise. The silver is not going to investors. It is going into the strategic reserves of Silicon Valley. This layer of demand did not exist in 1980 or 2011. Back then, silver was money. Today, silver is technology. And unlike coins or bars, silver embedded in a data center cannot be quickly recycled. That metal is locked away for 10 to 20 years. It is permanently removed from circulating supply. Add it up. Solar consumes over 20%. EVs consume another 10 to 15%. AI may consume another 10% or more. Nearly half of global silver supply is now spoken for by just 3 industries. That leaves very little for jewelry and almost nothing for investment. And yet, investment demand is at record highs. ETFs have seen sustained inflows and physical premiums remain elevated. Too many people are competing for too few ounces. The AI demand shock is the turbocharger on an already overheating engine. Even if monetary demand pauses temporarily, industrial demand will keep pushing prices higher. This is why the $94 breakout is fundamentally different. It is not built on hype. It is built on physical necessity. Banks can manipulate paper markets, but they cannot print silver for Microsoft. Eventually, the industrial user always shows up and demands the metal. And when that happens, price discovery shifts permanently. It moves away from speculation and into desperation. That is the phase we are entering now, industrial desperation. Look at the chart again. That vertical move to $94 was not excitement or hype. It was the sound of the market realizing there's not enough silver to build the future we have been promised. Celebrate the $94 handle. You were right, you were early, but do not get complacent. Just because the fundamentals are perfect does not mean the road ahead will be smooth. The banks are wounded animals. They have lost control of the long-term trend, but they still have claws. They still have algorithms, liquidity access, and the ability to manufacture violent volatility. That is why the next phase of this move demands discipline, not euphoria. In the next part of this deep dive, we need to confront the history of violence in the silver market. We must temper excitement with a serious warning. Every time silver breaks into new territory, the empire strikes back. If you lever up at $94, expecting a straight line to $150, you are walking into a kill zone. The AI demand shock guarantees the destination is higher, but the banks still control the road we travel to get there, and that road is full of potholes. Technology is changing the world. Silver is powering that technology. You're holding something extraordinary. But keep your seatbelt fastened. The turbulence is just beginning. The banks are reloading. Now we need to turn down the music, put away the champagne, and look at the battlefield with clear eyes. Because while the trend is undeniable, the path is dangerous. I know how you feel right now. You look at the screen, you see green candles, and you feel invincible. You start thinking this is a straight shot to $150. That feeling is exactly what the banks are counting on. They want greed. They want leverage. They want you logging into your brokerage account, maxing out margin, and betting everything at the top of the candle. Why? Because leverage makes you vulnerable. And vulnerability makes you huntable. To understand what comes next, we have to look backward. History is not optional in this market. Ignore it, and you risk repeating it with your life savings. Go back to December 29th, 2025. Silver had just broken above $80. The mood was identical to today. Social media was screaming $100. The confidence was absolute. Then the trap snapped shut. In a single session, the banks engineered a brutal 16% crash. Silver was smashed from $83 down to $70. It was fast. It was violent. Billions of dollars of retail capital were wiped out. Anyone who bought the breakout on margin was liquidated. Accounts went to zero. Now fast forward just 10 days to January 8th. The price had recovered to $82. Confidence returned. Bulls declared victory. And then it happened again. Another smash, another rug pull. The price dropped 12%, collapsing to $74. Headlines screamed double top. Weak hands sold at the bottom. Then look at January 15th. Silver tagged $93. Euphoria was everywhere. And by lunchtime, it was trading at $86, a 7% drop in hours. Do you see the pattern? December 29th, minus 16%. January 8th, minus 12%. January 15th, minus 7%. This is not random. This is an algorithm. This is a predator hunting prey. The banks see the order book. They know exactly where stop losses are clustered. They know that if they push the price down just far enough, they can trigger a cascade of forced selling. They use your leverage against you. They push the first domino, and your own stop losses turn it into an avalanche. Now here we are at $94, the highest price in history. That also means the risk of a washout is higher today than it was yesterday. The more crowded the long side becomes, the easier it is to tip the boat. This is not meant to scare you. It is meant to protect you. Consider this simple math. If you buy a futures contract at $94 and the banks engineer a routine 10% correction, the price drops to $84.60. If you are on 10-1 leverage, that 10% move wipes out 100% of your equity. You are finished, out of the game. And here's the tragedy. The next day, silver may rebound to $100 as AI demand and supply constraints reassert themselves. The rally resumes without you. You were right on the thesis, but wrong on the timing and structure. You got washed out in the dip. This is the vertical trap. The banks cannot stop silver from going higher long term, but they can still win the paper battles. They can still extract maximum pain from tourists who think this is easy money. This is why we repeat the same message over and over again: physical silver. Think about the investor who bought physical silver on December 29th at 83s, when the price collapsed to $70. Did he receive a margin call? No. Did his silver vanish? No, he waited. And today, at $94, he is up. Physical silver has no leverage. It has no stop losses. It cannot be hunted. A paper flash crash is just a headline. It does not change your ownership. We are entering a period of extreme danger. The $94 level is a target painted on the back of the bull. Volatility is expanding. We could easily see $10 daily swings. Imagine waking up tomorrow to see silver down $8. Would you panic? If the answer is yes, then your position is too large. You are overextended. The banks are wounded, but they are desperate. They are staring at losses measured in hundreds of billions of dollars. They will fight dirty. They want your silver to cover their shorts. Do not hand it to them. The trend is up. The destination is triple digits. But the road from $94 to $100 is a minefield. This brings us to the conclusion. You now understand the full magnitude of the moment we are living in. The trend is vertical. The fundamentals are undeniable. But the game itself is rigged. So how do you win a rigged game? You stop playing by their rules. You take your chips off the table. You walk out the door. This is the physical manifesto. For decades, we were told a lie. We were told that a piece of paper claiming silver is the same as silver itself. It was never true. Paper silver is a promise. Physical silver is possession. In a stable world, promises work. In a crisis, promises fail. And a 31% move in 19 days tells you clearly that we are in a crisis. Rule number 1, do not sell for dollars. The temptation is loud right now. You are up multiples. But ask yourself an honest question. What are you buying with those dollars? Are you parking them in a banking system that is technically insolvent? If you sell silver for dollars, you are trading a scarce asset for an infinite one that is being rapidly devalued. You are trading a lifeboat for a ticket back onto the Titanic. The dollar is not the destination. The dollar is the casualty. Silver at $94 is not silver getting expensive. It is the dollar getting weaker. Rule number 2, ounces to acres. You sell silver only when you can exchange it for a cash-flowing hard asset that feeds and shelters your family. Historically, in 1980, it took roughly 800 ounces of silver to buy the average home. Today, even at $94, it still takes around 4,500 ounces. We are not there yet. You wait for the ratio to compress. You wait for the moment when you can walk into a closing, slide a monster box across the table, and walk out with a deed. That is not speculation. That is generational wealth transfer. Rule number 3, prepare for cash settlement. If you hold ETFs or futures and silver spikes to $150, read the fine print. They can settle you in cash. They can close your position and mail you a check. Then you take that check to a coin shop and discover the real world price of silver is $300 if you can find any at all. You are paid in a currency that can no longer buy the asset you thought you owned. This is why physical silver is the only manifesto. It has no counterparty risk. It cannot be defaulted on. We are at $94. The psychological gravity of $100 is pulling the market higher. Everything points up. But remember, the banks are watching. They may try one more smash to $88 to flush out weak hands. If that happens, do not panic. Look at your stack. It still weighs the same. It still shines the same. A paper smash is a gift. It is one last opportunity to exchange dying dollars for living metal before silver becomes unobtainable. The train is leaving the station at 94 miles per hour. Hold the line.